Money is intimidating for folks and scary. And we have that emotional aspect and worry and panic. So how do you help people with that?
What we try to educate our clients is don't be chasing returns. Don't be focused on headline news. Have a solid plan in place and live life. That's what it's meant for.
If you look at your income, what % would you recommend that folks put aside to invest?
I go off of kind of the 10% rule. And that 10% rule is take 10% of your income, pay yourself first, and then after that, do whatever you want. Welcome back to another episode of the Retire and Thrive podcast, where we help you live your life with purpose, wealth, and confidence. Welcome, Kamie.
Hey, thank you. I'm Kamie. This is Dan. He's our expert here. And we are so excited that you're joining us for another episode. We love all the comments people are passing along our way and people that are thoroughly interested in retirement if they aren't there yet, or others that are showing a little bit of concern as they do hit that retirement age. This week, we have so much to talk about and so many tips to give folks.
Yeah. And I think back to the previous 3 episodes that we had done outlining that first chapter about giving yourself freedom. And like you said, we've had several comments about that. And it's kind of fun to see people embrace that stage in retirement.
And we thank everyone who has subscribed already to our channel. We hope that you click the button, subscribe. And if you turn your notifications on, you will be notified each week when a new episode drops.
So this week, I think we're going to go into lesson 2. And lesson 2 is to reap the rewards.
Yes.
You must review your investments.
Yes. So Dan, is it true that when we hit that retirement age that folks need to transform how they are investing and strategize maybe a little bit differently than how they were before?
Yeah, great question. And I think, the way I look at things is we go through life mainly in either the accumulation phase or, as you said, Kamie, as you approach retirement, the distribution phase. And so oftentimes when people start approaching that retirement age, that's when they start getting a little bit nervous and they're like, do I have enough money? Should I be, changing allocations? And certainly I don't feel like it should be done just right when you retire, but certainly as you progress along that accumulation stage.
Okay. So what advice do you have for folks who are, let's talk about that retirement age, and maybe they've been investing properly their entire life. And now that they're at that age, they maybe have a little bit more money that they can work with, but they're concerned about where they're going to put it.
Yeah, I think that, when you're younger, you can withstand some of the volatility. You can withstand some of the storms that we've experienced. Yeah, exactly. Time is on your side. And so, just when I think back just over the last 5 years of the things that have happened, I mean, we've had everything from COVID back in 2020 that sent the markets tumbling down. And then we started to come out of that recovery. And inflation was out of control. And so then we saw the Federal Reserve raise rates substantially. And so we saw the bond market literally had the worst year in 2022 that it's had in the entire bond market history. And then we think we're out of the woods. And then all of a sudden, first quarter of this year, then tariffs hit. And so it's caused a lot of uneasiness. And so, I feel like as you're approaching retirement, certainly dialing back that risk, whatever that means to different people. But you move more from that stage of I can withstand some of the volatility to I want to protect some of this. And how do I turn, which we'll get into here in a little bit longer, a little bit further here, but how do we turn from the accumulation phase to actually turning this asset, i.e. a 401k, 403b, or whatever the retirement is, how do we turn that into an income source?
Yeah. And I think a lot of people that maybe worries them because they aren't quite sure how that works. And I know you have a couple personal stories that you wanted to touch on, your personal experience about what happened to you. Great that you're going to share that with us because I think people can relate to that because it is scary. I mean, if you're looking at decades of time, there have been some scary times in these past few decades.
I think for myself, being, at this stage of my life, Kamie, I've been doing this for 30 some years. And we've had some very, very big roller coasters. And, the couple that come to mind for me, I look back in 2008, with the financial crisis and the whole real estate, that was really scary for a lot of people, and rightfully so. I mean, there was just a lot of uncertainty. I also think back to, going back to me personally, I worked for a big bank, worked for them for about 8 years, built up a nice retirement plan. And kind of tying this into retirement and how you need to look at your allocations, I look back on that period of time. I was in my late 20s. And for a lot of viewers, if you're younger, you may not recall this, but back in the late 90s, technology just took off. Mm-hmm. And so it was everybody was jumping on the bandwagon, and there were a lot of different companies, specifically technologies, that were doubling and tripling. And so for us, it was really about, how do we allocate portfolios? But for me, I was young and I thought, let's just go after it. So literally when I left my previous employer, when I was at the bank, I put everything that I had in my retirement into the NASDAQ, which basically is all technology companies, because that's what was going up. And I felt comfortable with that.
Everything. Was that a personal decision, or did you have someone guiding you?
No, that was me, because, I was fairly new as an advisor. I'd had 8-9 years of experience, but it's kind of like jumping on the bandwagon. It's like, it's working, it's working, it's working. So let's just put everything in there. And I'm young and I can withstand some volatility. And so I did that. And again, for, those of you that remember, there was something that happened in 2000. We called it the tech bubble. And literally from 2000 through 2002, Kamie, the NASDAQ, that technology sector, dropped more than 50%. And so for me, that was like a big deal. I mean, literally saving for 8 years and just seeing half of it just vanish. And, hindsight is it was okay because eventually it came back. But what people didn't realize is it took 10 years. It wasn't until 2010 in that technology sector before it came back. And so just imagine if I were 55 years old back then, and I put half of my money or put all of it, and I lost half of my money. And, the dollars are typically quite a bit bigger when you're approaching retirement. And imagine that gut-wrenching feeling that if you lost half your value and you're ready to retire in 5 years, that would be very scary.
Mm-hmm. So we're talking about looking at your portfolio and maybe giving it a checkup with this episode here. Why is that so important? And is there a way to check on your portfolio without an advisor, or do you highly recommend a financial advisor?
Yeah, and I don't want to be biased here and say you need a financial advisor, because we have people we work with that are fairly astute. They love following the markets, might buy some index funds, and that's great. But I think at the end of the day, it's really important that you do check in, how your allocations are. And so for us, when we look at things, not to divert the question here, but you don't have to have a financial advisor to rebalance your portfolio. I think one of the things a financial advisor brings to the table is they're in it daily. They're looking at this. They're getting resources. Like I've said before, we partner with Fidelity. We get insight from them. We find out what they think the economy's at, where it's going to be going. Not that they're right all the time, nor is anybody, but absolutely. If somebody's comfortable managing, their overall allocation, what we tend to do is we fine-tune that. We may add a little bit to one asset class versus the other. But the scary part is we have found a lot of people that have worked their entire life, say, for one company, and they're getting closer and closer to retirement. And we will sit down with them and we will ask them, so when's the last time you've kind of reviewed your 401k or your 403b? And you'd be shocked. I mean, oftentimes it's like, well, this is how I allocated back when I started. Yeah. And here we are 30 years later, and I still have 90% of my money in the stock market.
I don't know if I'd be shocked, but as a financial advisor, you probably are shocked.
Right.
And maybe a little bit disappointed. But I can see that happen. Money is intimidating for folks and scary. And we have that emotional aspect and worry and panic. So how do you help people with that? You mentioned, okay, maybe this person hasn't touched their 401k since for 30 years, they've been just doing the same thing. How can you help people make the right decisions and then try and not get the emotional side into things or the panic? What are some tips that you have for folks?
Yeah, great question. And I think for us, everything centers around building a plan. And I don't care if you're in your 30s, your 40s, or even in your 60s. It's kind of like, it might be a little bit of a corny analogy, but it's like if we were hopping into a car and we wanted to drive to Dallas, Texas, but I didn't have a phone or GPS. I know I need to go south, but I'm not exactly sure where I'm going to go. Right. So that's where, a plan comes into place. And so I look at retirement kind of the same way. That is it important when you're in your 30s and 40s to at least have some kind of direction? I personally say absolutely. Because in today's world, there's lots and lots of choices. There's, even for the 30, 40-year-olds, do I put all of my money into the pre-tax in the retirement plan? Do I put some into the Roth? How much should I put in? I mean, all these things do matter, but you won't see the implications of that till you actually retire. And that is one thing, and we'll talk about this in one of the other lessons in the book, is one of the challenges we find is that people that are now retiring, Kamie, they maybe maxed out their 401ks and didn't even think about putting any into the Roth component. So now when they go to retire, it's a large percentage of their entire net worth. So we have people that might have $1 million, $2 million in their retirement plan. They retire next year and 90% of their net worth has never been taxed. And again, I don't want to go into too much detail right now because we are going to get into that in future episodes. So I think it's important that people have a plan in place so that they can at least have some direction about where they're going to go. And again, we'll talk about that coming up also. Mm-hmm. Where does the money come from? Does it just come out of thin air? Of course it doesn't. But we'll get into that in the next lesson, which is the cash flow section, which we'll talk about down the road.
Okay. And just to somewhat recap here, when you say, okay, we hit that retirement age and you say, let's check up on our portfolio, what are the first steps for someone?
I think the first steps are looking at the overall allocation. I mean, I look at things in a very simplistic way. I mean, Wall Street can get a little bit complicated and you're talking about all these different types of investments. But the way I look at things, Kamie, is you've got stocks, you've got bonds, and you've got cash. And pretty much everything can fit in there. You could possibly add in another category called international. And so when you look at the variability or the fluctuation of those assets, I mean, stocks are going to fluctuate more than bonds. Bonds are going to fluctuate more than cash. And actually, next episode, we'll start talking a little bit about this, what I call the bucket system, and where to put money and how to invest it. But yeah, absolutely, it's important. So what's the first step? We want to take a look at the overall allocation. And that's one of the things that we've talked about with some clients that maybe haven't rebalanced or modified their retirement plan in 20, 30 years. It's like they could withstand some volatility in their 30s and 40s, but all of a sudden they get into their 50s and 60s. Not only are they not able to withstand the volatility, kind of like my personal story. If I'd done that when I was 55 and it took me 10 years to recover, my whole retirement plan has changed forever.
Right, right. You mentioned we will talk about this in a few later episodes, but what if you get a client and all they've been dealing with is cash? They just haven't invested. Their money's in the bank. Maybe they have a lot of money. Maybe they don't. Maybe they're 20, 30, 40, and they just put their money in the bank and they're finally trying to educate themselves on investing. What advice do you have for someone like that?
Yeah, that's again, another great question. And I think, there's been lots and lots of studies done that a diversified portfolio is actually going to deliver a better return long term. And I know we mentioned this in one of the earlier episodes, but now we have clients that are actually living longer in retirement than they actually worked. So imagine somebody at age 60, they maybe worked for 35, 40 years and they live into their 90s. That money has to last. And so as far as the investment side, if somebody's got all this money in cash, I think the two challenges for that, quite frankly, is one is they're dependent on interest rates. I mean, everybody can remember buying CDs at 7%, 15 years ago. And just recently in 2022, when the Fed raised rates, we could go out and we could get some CDs at 5.5% and 6%. Whereas 2 years earlier, we couldn't even get 1%. So the point that I'm trying to make is the variability of interest rates is going to depend on how much your return is going to be. So if I got $1 million in CDs, Kamie, and 2 years ago I could get 6%, that's going to generate $60,000 a year. Fast forward to today, you can't get 6% on CDs. You might get 3.5%. So all of a sudden now your income went from $60,000 to $35,000. So a substantial reduction in income. And then you couple that with the second point that I'm trying to make with having everything in cash. Has inflation gone up or down in the last few years? It's gone crazy. So if I've got everything in CDs or I've got everything in cash, and I went from getting 6% to 3.5%, the cost of goods has continued to go up, but yet my income just got cut in half.
Right. Okay. Anything else that you'd like to touch on for this episode, Dan?
Yeah, I think one of the things that I would say is that, if you have a financial plan, regardless of your age, I think it's important that you review that financial plan. And what we find is that when we build out financial plans, and again, the majority of our clients are retired, so that tends to be where we're focused. But our whole thing is, it's not really that important what your investment returns are. And so if you have a solid plan in place and we've built in some contingencies if the markets go down and some different strategies. Again, we'll talk about that in the next episode. But I would just encourage everyone to stop focusing so much on the return itself and just start living. And again, that goes back to, the original lesson, which is enjoying the fruits of your labor. And so for us, we want to empower people to, have a solid plan, but don't get caught up in the headline news because, just as an example, here we are, the tariffs were such a scare the first quarter. And now we've got the passage of the new bill. Tariffs are still a little bit unsettled. But if I go back to the first week in April, and I fast forward out just a few months, the market's up, if I look at the S&P 500, up almost 30%. So imagine, and again, actually, we are going to talk about a little bit of emotional, so I don't want to get too into the behavioral finance here, but that's the importance of a plan. And so what we try to educate our clients is don't be chasing returns. Don't be focused on headline news. Have a solid plan in place and live life. That's what it's meant for.
Yeah. And not to get too far into the weeds on it, but having that financial planner or advisor might be better than watching the news and looking at those headlines for your personal finances, just because there have been some inconsistencies and some mispredictions.
Right. And we've seen that, across the board, whether it was during COVID, whether it was through 2022, and even the experts aren't always right either. And so, our advice is look at things from a longer term perspective and don't get caught, on the day-to-day basis.
Okay. Yeah. Good advice there. For our younger crowd, quick question for you. You're probably not going to have a specific answer, but if you look at your income, what % would you recommend that folks put aside to invest?
Yeah. Great question. I would say first and foremost, if you have a retirement plan offered through your employer, always put in at least what the company is matching.
Yeah, of course.
And of course, the matches varies. Some might do 50 cents on the dollar up to 5%. Some might do dollar for dollar up to 3%. Whatever that match is, at least put in that much. And I know for the majority of people that seems to make common sense, but it's interesting when you find people that don't do that.
Right.
And the way I look at it is this: it is free money. But if
grows.
But if I take an employer who's doing 50 cents on the dollar up to 5 or 6%, the stock market, Kamie, historically has averaged around 10%. If they're matching dollar for dollar of 50%, you're getting a guaranteed 50% return on that money, 5 times more than what the stock market has historically done. So that's a no-brainer. But back to your original question, I think it really depends on what you want in retirement. It's really hard to convince a 25 or a 30-year-old to put 15, 20% of their paycheck into a retirement that they may not even see for 30, 40 years.
Yeah.
But as a general rule, I go off of kind of the 10% rule. Mm-hmm. And that 10% rule is take 10% of your income, pay yourself first, and then after that, do whatever you want with that.
Sure.
Yeah.
Sure. So it's just, if you want that for retirement or if you want to go on a trip now, which I think a lot of younger people have been doing, that's up to you.
And I've used this phrase before, and I think it's applicable here. But when I look at retirement, when I talk to the younger generation, I tell them that retirement really boils down to really 2 words, and it's called deferred gratification.
Mm-hmm. Right.
Do I want to enjoy it now or do I want to defer it? And I said, you need a balance there.
Yeah, absolutely.
And my last thing I want to just comment on that is I would encourage all of the people that are contributing to their retirement plan, do a percentage of your income, not a dollar amount. And the reason being is, the intention or obviously the objective would be is as your income grows, that if you keep it as a percentage when you get raises, the dollar amount actually goes up with your income.
All right. Well, that is all we have for this episode. Next week, we're going to be talking about buckets.
We are going to be talking about buckets, and you might be thinking, what kind of buckets are we talking about?
Yeah.
So we're going to shift a little bit about more of the income side of this. And so we have a couple concepts that I want to introduce. And one is the bucket system, as I refer to it. Another one is income streams. And then the third thing that I want to talk about on the next episode is putting up the guardrails.
Okay.
So we don't go off the road.
Okay. We're putting the gutters in the bowling lanes next week.
Yeah, that's good analogy.
Do you need those or no?
I don't need them.
I don't either.
Yeah.
I don't either.
You're probably like a 200 bowler.
No, I'm not.
Yeah.
No, I've maybe hit 200 once or twice, but no, very hit or miss on the bowling lanes. Thanks so much for joining us this week. We look forward to seeing you next week. Again, if you have a loved one or maybe it's you that needs to be reminded to double check that portfolio as you head into retirement, this episode is for you. Passed along to one of your friends as well. We really appreciate that. And subscribe to this channel. We will have new episodes every week.
Excellent.
That's all from us. We'll see you next week.